Good afternoon, it's Christian Thwaites from Brown Janikowski, Tuesday, March 8th, after the markets have closed. Well, it's been for about 2 weeks now that we've seen the S&P trade within this narrow band of about 1850 to 1950. It closed just below that level today. We kind of like the fact that the market seems to be settling in a little bit, but this is still a very risk-averse market, and there's really two places to look at to see that risk aversion play out. The first of all is in the US Treasury 10-year bond, which has gone between about 165 at its low to about 190 and is today around about 180. Anytime there's any concern on the major markets, the US Treasury rates will go up, and that's what we've seen. And the other place where the risk aversion is playing out is in the Japanese yen, and that seems to be a favorite currency, especially for Chinese investors, and that has been up about 12% since the Japanese central bank cut rates in the end of January, and in fact in negative rates. But take a look at this market, because this is very important for our market discipline. You can see that this is from the lows around about 24th of February, of the lows of this year. The market, the S&P, as you can see over there, is the lower line, up about 3%. But look how fast the emerging markets have come back, which we thought they might, although this has been fairly rapid growth. It's up nearly 7%. It tells us two things: that people are looking around for some valuations and opportunities in emerging markets, as we hoped and thought they would. But it also means that it's important to stay invested in these markets, because when they move extremely quickly, and we continue to like emerging markets on a relative value basis as well as their long-term growth opportunities. Important day this week. The ECB will be out on Thursday. The Fed meeting next week. We'll report back at the end of the week with our thoughts on the conclusion of that central bank meeting. Thank you very much.